The Fed just admitted something quietly, and it's going to hit the housing market like a freight train. For the first time since 2022, central bankers are signaling real fear. But it's not the usual panic about high rates or affordability. It goes deeper.
So this is interesting. This data says behind the scenes demand is collapsing. Deals are falling apart. In fact, it shows that 1 out of 6 contracts are now getting canceled before they close. Meanwhile, inventory is rising in key markets, even the ones that were safe just a year ago. So you combine this with rising supply, buyers backing out. There's only one direction prices can go, and that is down. But it's not just about the numbers. This is really about the silent collapse of the financial confidence that props up housing.
Yeah, Mitch, you are exactly right. And the data supports this. So the data shows that 5.3% of contracts are falling through. So this signals that buyers are scared. And I get it. It is falling confidence. Listings are up nationwide and sellers are starting to price properties down, right? So, as an example, 2022, a home that was listed for $400K, today in 2025 might be listed at $580,000. But interest rates are up. So affordability, it's challenging, right? A home that might have cost $1,300 a month, $1,300 a month to own is now costing $3,000 plus to own. So, what that means for today's investors, shit, you tell me, Mitch.
Well, I think, first of all, I like to, step back and look 30,000 foot because it's like what's happening in the greater economy. And then, of course, we can apply that to our lives in investing. I think we're in this situation where interest rates are starting to come down. We've seen a 25% basis point reduction, but they've also signaled another 50 basis points, maybe 75 basis points in the future. So we could see a period where buyers are actually still holding off, waiting for those next interest rate reductions. So there's not necessarily a rush on housing now, but there could be later on. That paired with we have higher inflation, we have bad jobs data. So I think there's this weird dynamic where buyers are going, let's wait a second, and the economy is in a rough position. We could see sort of a bit of a stalemate. In other words, where buyers are not coming off the bench quite yet, but sellers still need to sell. I mean, the data shows 20% increase in listings. And like the data says, there's only one direction housing can go, and that's down. So I do think in the short term, you're going to see, price reductions, sellers, for whatever reason they need to sell. But buyers could be holding off, which actually could mean inventory rises, prices go down. Now, beyond that, what's interesting to me is when equity disappears or decreases. We talked about this on a past show. People's confidence drops. I know I felt it before, right? When I remember way back in the day, I was like, oh, I'm house rich because everything went up, right? And I felt wealthy. And so that means maybe I'm going to go spend, or I'm going to buy a car, I'm going to go on vacation because I know I have this sort of nest egg. When that starts to go down, even if you're not refinancing or selling, that does affect the economy. And we saw that in 2008 as well. People walked away. So I think looking at this big picture, what's going on and then what are the psychological effects? And then we can connect that to other assets like commercial real estate, the world we live in. So what are your thoughts?
Yeah, I mean, the psychological aspect I find really interesting because I have seen this play out, right? I call it phantom equity. You have all this equity, whether it's in your personal property, whether it's investment property, people feel wealthier. And when people feel wealthier, they do tend to spend more, or they think that this wealth is going to build forever. But it is phantom equity, right? They're not actualizing the average homeowner that owns one home and no investment property. They're not typically actualizing the equity in their home. They feel wealthier. And sometimes they do make, psychological decisions. They go spend more money. They actually borrow more money. If interest rates are low, they might even do a cash out refi, and they go spend that money on, in a lot of cases, liabilities and things that don't actually increase their wealth. And then when that changes, they're stuck with, a higher payment, less equity because they pulled a lot of the equity out. And then also psychologically, when the market shifts, people, they look on Zillow and they go, oh my gosh, my house is worth less. They feel poorer and they make decisions, on that. So I think, as a prudent investor, it's important to I think check your mindset too. When you're basing decisions on emotions, or I guess more particularly, I like to say when our emotions run high, our intelligence, I think, runs low. And so if you're only making emotional decisions, oftentimes we can make the wrong decision, right? And so as a market shifts, I think it's important to be paying attention to like, what is it that you can do? What can you what actually affects the deal, right? Looking at investment property in particular, like, are there still deals to be made? Absolutely. Can you still go out there and build relationships? Yes. Can you still underwrite deals? Can you make offers? Absolutely. Now, whether or not every one of those are going to stick, that may not be the case, but that's never the case in any market. And I think, another piece of that is like those sitting on the sidelines just waiting for properties to be more affordable or interest rates to go down is not the play. Like, you need to get in the game today so that you're ready when the market does shift to take action on buying the property that you want to buy. You're not going to see a great deal if you're not ready to take down a great deal.
I agree. And I think too, what's important about this data is like, we can, I'm always curious, like, what does the country feel like? What do people feel like? What do investors feel like? And I think that there's fear entering the market. We have unknowns both in our country as well as wars overseas, and different things, different levers are being pulled in the economy. And so I think change creates fear, but fear creates opportunity. More millionaires come out of a situation or a time of fear than they do out of a time of confidence. When people are confident, they're going to hold on to properties, they're going to sell top dollar. Versus fear, you got to think like these owners that own these properties are in all different stages of their life. They could have a business that they own as well, and they're nervous about their business because fear's entered their mind, so they want to sell their commercial property, or they could be facing retirement in the next couple of years, and they go, look, this thing could be wiped out, because they're, usually fear goes way beyond the actual reality of the situation. So I do think when fear enters the environment, if we can keep a steady state and keep a sort of like the wits about us, then we can actually go into the marketplace and make better deals than when the market's really confident. Fear is not a bad thing if used correctly.
I agree, but I also think, I think homeowners and investors feel trapped, right? There's a lot of investment properties that it's difficult to refinance right now, and it's difficult to sell for a profit, right? If we look at where prices are and where interest rates are, we have investors that they feel trapped, right? Like, it's not like it was in 2020 in 2021 and early 22, where they could go refinance, pull cash out, and then redeploy that capital. We had prices up and interest rates down. And so there are a lot of investors that I think they're in this position where it's challenging to refinance, especially if they didn't underwrite the deal with any kind of downside or interest rate, really stress test the property. And oftentimes they can't sell for a profit. So then they're stuck with that property. And on top of that, right, you have, potential defaults. You have commercial loans coming due. Banks are surely tightening their guidelines. I mean, shit, I'm in the middle of a refinance right now, and I'm being asked, and this isn't one of my giant property, like one of my big properties, right? Like, they're asking for, like more than I've ever been asked for, right? And so, like, as the economy changes, things like that does happen, right? Like, banks do tighten up their guidelines, which I don't necessarily think is a bad thing, but it puts an investor or a homeowner in kind of a sticky situation if they're trying to sell, trying to refinance, and they can't actually capitalize on some of this equity or this phantom equity that they've built over the last, decade.
Well, the other thing too is like, and I agree, people do feel trapped or could feel trapped, but if you're in real estate, it's a great place to be trapped, by the way, as long as you can hold that property throughout time. We talk about this, we talk about cash flow real estate. The reason being, it gives you lifestyle. It also pays for itself. So you're not working extra to keep a property that's cash flowing positive, right? It's paying for your life, and you can hold it throughout time. I think the journey up and to the right is wavy. And we hit these peaks and these troughs, right? So like, you're like, oh my gosh, times are good, interest rates are low, I'm doing really well. Or, you know what, times are tough, like my equity's disappeared, I feel trapped, I can't refinance, all these things. But the fact is, you could just be in a trough on your journey up and to the right, because real estate over time, so far in our country, has always been up and to the right. And so I feel like I look back at my journey, and there's been moments where I wake up and I go, man, like, things are tough right now. My equity's low on this, or this property's tough, or this isn't a bad situation. But holding those properties has always benefited me. It's always brought me wealth, equity, cash flow over time. And so I think that's why we always go back to the fundamentals we talk about is holding cash flow real estate allows you to ride the peaks and the troughs as everything moves up and to the right. So if you're listening to this and you feel trapped, real estate's forgiving over time as long as you can hold it. It's when you sell in a trough or you knee-jerk react, I think that you give somebody else a good deal.
Which we talk about this a lot in our elite mastermind, like how important cash flow is, how important it is to underwrite a deal on the day that you purchase the property, and based on, the actual historical data, not just hope that the property is going to go up in value and hope that you're going to actualize these higher rents. Like, what is the property doing when you purchase it? What's it historically been doing? Because to your point, Mitch, like if your worst case scenario when you're trying to refi or sell a property, like I'm in this situation now. I've been selling some of the properties that I've owned for 15 years, and there's a lot of equity there. Some of these properties flew off the market earlier this year, and some haven't sold. My worst case scenario, it's like, oh shit, the property didn't sell. I guess I'm just stuck with this cash flowing property for a little longer. Keep in mind, every month there's principal pay down, and over a long period of time, this property is going to be worth more and more. Oh, well, worst case scenario, I just keep cash flowing every month, right? So it's because I bought those properties on fundamentals many, many years ago. So I'm not ever putting myself in a position where I have to sell. And rarely am I putting myself in a position where I have to refinance, although some of these commercial loans do come due and I need and want to refinance, right? But because I've underwrote these up front, because I bought these for cash flow, I'm not putting myself in a position where it's like, I have to sell. And when worst case scenario is the default setting of buy and hold and let the property cash flow, that's a damn good default setting and in my mind.
I agree. I completely agree. And I think, being an investor, a cash flow investor, you've got to develop the skill of analyzing the waves or the ripples, but understanding where the tide is going. And what I'm saying is jump in the data, right? We can look at housing data and we can try to relate that to how it's going to affect our world. And we can watch interest rates and we can read the news. We can do all that stuff, which there's important aspects to that. But then stepping back and saying, what's the big picture? The big picture for me, if I can hold real estate throughout time, I'm going to win. And when I say hold real estate, it's not punishing me to hold it. I'm not having to work 2 jobs to hold it because it's negative cash flow. It's actually giving me a better life because I'm holding it. It's giving me cash flow. It's giving me equity. It's giving me all those things. So we have a property right now that just fell out of contract. We had a good offer on it, fell out of contract. Well, again, my worst case scenario is I just get to hold that asset. We'll go out to market and see if we can get a good offer. If we can't, it's no big deal. We'll hold it for another year. We'll continue optimizing the property and we'll hit our values. So I think diving into the data is important, but then stepping back and having a very clear understanding of how real estate performs over time is really important because it gives you that confidence to say, okay, if I can hold this and times are bad right now, so be it. That's a short-term thing. Long-term real estate always pays. It does a great job, especially if it's cash flow. Now, if you're holding a piece of land because you want to develop it someday, that's a different story, right? You have holding costs, you're paying HOAs or whatever that is, and it's negative. So that's gonna rely on you working and feeding it. That's a different thing. But cash flow real estate, the ability to hold it is a really important thing. If you can hold it forever, then I think you're going to win.
Yeah, and there's opportunities in every market, right? In every cycle, regardless of where interest rates are at. In fact, I would argue that there's a little bit of a myth that lower rates will fix everything, right? When rates come down, and we've seen this every time interest rates have come down, you have higher prices, you have bidding wars, you have cheaper money out there and easier access to money. People are actually bringing the prices up. So yes, you have more buying power because interest rates are down, but you're paying a higher price for that. And so on residential real estate, if you can lock in a 30-year fix at low interest, great. But commercial lending, you got to understand, rates come down significantly. You're locking that in, but a lot of times it's for 5, maybe 7, maybe 10 years. But usually you're locking in that rate for 5 years. But at the same time, rates are coming down, prices tend to go up. You have more buying power. You can buy and pay more for the same property, right? And so I think people need to a little bit of a reality check that lower rates doesn't just all of a sudden make the market better. In some ways, it actually, I think, creates a scenario where people are overpaying for properties because the debt's so cheap. We saw this a lot at the end of 22 when rates essentially doubled and people are going, oh my gosh, it was so easy to buy this property with cheap money and they paid a lot more for it. And now those loans, we did a whole episode on this. Now those loans are maturing. and they're going, oh shit, this property is not worth what I paid for. I can't get debt on it to even cover I can't get good debt service on it because rates have doubled and I still owe X amount of dollars on this property.
Yeah, I think that people do look at the rates as something that's going to save us. But it's really it's something I think people discount, that the prices increase with rate reduction, they decrease with a rate increase. And the reason for that is people want to borrow at one rate and get a different return, right? Or a better return. So they want to get a positive leverage on their money. And that's why we see that sort of adjustment when rates go up, prices go down and the reverse happens. So I don't think the rates are going to save us. I think that they may stimulate the economy and turn around our jobs data potentially. But in the end, I think that it's really back to finding properties and assets where you can negotiate a deal where the difference between the return that you get and your rate is solid and strong to where it gives you good cash flow and good cash on cash. I mean, that's what I'm looking at right now today. We're buying a property today and I'm looking at a 9% operating cap rate, but a 6.5% loan. I've got a 2.5% spread, meaning I'm borrowing from the bank at 6.5 and I'm making 9% and I've got a spread there. But you can do that in any rate environment. So I don't think that looking at rates as a savior is the right approach.
Yeah, I mean, real estate's a long-term game. I mean, you can make some short-term moves, but really, real estate, again, we say it all the time. It's not a get rich quick. It's a build wealth slowly. And in 10 years, 20 years after you start accumulating real estate, you look really smart and you look like you've made all these, these great moves and timed the market perfectly, but really it's time in the market. It's paying attention to the market, but not letting the market dictate, every single move. And it's really just going out there and buying some cash flow real estate.
I love that. And I'll say too, as a final note, if you're holding a house right now and you're seeing equity disappear, don't knee jerk, because that's when you give away equity. I would say if you don't need to move, don't move. If you don't need to sell, don't sell. Stay confident and focus on not the lack or the scarcity mindset, but where are the opportunities? Where can you go take advantage of fear entering the marketplace? And that's where you're going to win when you can play offensive when most people are playing defensive.